Okay, let me get going so I can keep you running on time in case you especially have haven't had anything to eat today. My name's Josh Horn. I really appreciate your time today. This topic is state and gift business valuations, and it's specifically designed for attorneys. I've been grateful to be involved in several of these since I opened my practice. They are challenging and yet they're also a lot of fun. So there's a lot of interesting dynamics that happen here as far as the technical side as well as the family dynamics. And I think it's important to try, you probably already know this if you do this work, to be empathetic to the client because they're usually facing something that is devastating to them. Maybe they've lost a parent or a sibling or something like that. So there's a lot going on here. I'm going to focus primarily on these four broad areas, which are the risks of waiting to plan to do the estate planning, fundamentals around the business valuation side, what I see from my side of the desk, practice opportunities, which we're going to get into the second session next week. Hopefully, I have time to do that. If not, I'll get you the recording, and how to get started if your clients are moving in this direction with either an operating business, which would be like a construction business or a dental practice or a plumbing company or anything like that, or what like to call an asset holding company, which may have real estate, farm ground, those types of things in it. So if you have clients that are in this realm, and steal a little bit of my own thunder here, particularly if you have clients, I'm going to show you why. If you've got clients, single clients that are at roughly $5 million of net worth, you have married clients that are worth roughly $10 million. That doesn't sound like a lot now, but if the sunset happens, then that's going to be a real problem for them if they haven't done adequate planning. I'm going to show that to you. So the most common people I see on the team are you as the attorney, the CPA or accountant, and myself. So typically the three of us need to work together to get through this. And so we get to know each other usually pretty well. And what I like to do is really over communicate, because if something falls through the cracks, it can be a real problem. So let's get to it. Let's get to just a little bit about me. I'm not going to spend too much time on this since we're short on time as it is. I started my practice in 2016. I've been a certified valuation analyst since 2008. I've been a CPA for a lot longer than that, so 99 roughly. I spent a lot of my career working in tax, income tax, CPA firms, wealth management. So I did about 15 years of tax. I was also a controller for a large private company. I valued a lot of different kinds of businesses. I was on the NACVA standards board, which sets the standards for the membership of NACVA, the National Association of Certified Valuators and Analysts. And I was chair for 1 year on that board, and really proud to work with some really smart people there. I'm on this NACVA current update and valuations instructor team too. So let's go through the objectives on part one, which is today, just shooting for 30 minutes. So I'm going to show you the sunset provision that's coming our way and the risk of not doing estate planning or not doing enough estate planning. The date, standard, and premise of value, I'm going to describe these and show you how important they are. They lay the foundation for a lot of what we do as business valuators. IRS Revenue Ruling 5960. Just going to give you a broad view of this. This is the key thing we look to do this work. It was the seminal ruling on business valuation, particularly of private companies. Due dates in your calendar, IRS and states. And what I'm talking about here, I'm talking about states where the estate tax could apply. So it could be Illinois, or it could be Indiana or Florida or Texas or whatever it is. just going to talk about briefly things to be mindful of in that area. Operating versus holding companies. I touched on this briefly in the opening. I'm just going to give you my perspective on that and what I've seen. Day two, discount for lack of control, discount for lack of marketability, the three-legged stool. I'm going to keep you in suspense on that. Turning past estate disasters into future opportunities. And this is an area, even if you don't want to do it on the webinar, I would love to hear your stories from the trenches, even if it's on a phone call, because these are the areas I think we learn the most from. Obviously, we're not aiming for our clients to make a lot of errors in their estate planning, but they do happen. And I'd love to hear some of them. I'm going to give you some of mine in the second round and why I kind of my bullet points around planning have a lot to do with what I've seen, the repeated errors again and again. Create your action list for the planning piece primarily, and then how to get started on a business valuation for estate and gift. I'm going to give you my opening template I use for clients, prospective clients. They could become clients. Basically, if I get an inbound request via email, phone call, or whatever, how I start, particularly in this, tailored to this specific area. So let's talk about the sunset and the risk of not doing estate planning. And this is just real simple math. It's probably not perfect, but it's close. It's close enough to drive home the point to your clients what they are looking at if they don't do the planning that you, as the expert, are going to be able to give them to hopefully mitigate or eliminate this issue of estate tax. I'm going to give you a number example after we go through this, but I just want to outline the bullet points around this. So ET, it stands for estate tax. On January of 2026, the exemption is going to drop, barring a change in the legislation, from 13.6 million in 2024 to 7 million in 2026. So that gives you a sense of how far it's coming down. The planning must be done by December 31st of next year, which is coming very quickly. It may not sound like it's that close, but those of you that are busy and working hard every day and your clients are busy and they've got a lot of balls in the air, that's going to be on us very fast. My experience, and maybe yours is different, that many do not know the value of their business or their real estate, certainly not closely. They might have a ballpark, but they may be way off. And I think a lot of times it's kind of out of sight, out of mind. If they haven't gotten recent appraisals or business valuations, they may have no idea what it's really worth. And a lot of people that I run into do not prepare annual net worth statements as a matter of habit. And this could be a ticking time bomb for your clients. And I'm going to show you numerically why. And this is really, I think, a simple one just to illustrate what could happen. On this example, I'm using some pretty high numbers to illustrate the point, but I think, you can still, you could drop them down and feel free to reach out to me. I just can change the numbers and estimate what it's going to be. So on the top, we have a married couple. On the bottom, we have a single person. And we're just moving. All I did was from left to right, the change for a couple that has $30 million in assets and a single person at the bottom that has $15 million in assets. And what you can see is the estate tax goes from, on the married couple, from about 1.1 million to 6.4 million, which is about a six-fold increase, right? Same way on the bottom, from about 500,000 to 3.2 on the single person, the increase in the tax of 2.6 million. So that's less money getting to the beneficiaries, more money paid in taxes. And this doesn't even include the potential impact from state estate taxes at the state level. Let's see if there's any. Anything I forgot to tell you about here? So this just gives you a sense of what could happen, especially if they don't do the planning. I think the thing to keep in mind here is that if you're looking to put clients on your radar, I think that you really need to be focusing on the singles that are 5 million and the couples that are 10 million, because they each of them could potentially come into another inheritance before they pass away and push them over the number. So I would suggest that you really be as conservative as you can in terms of the ones you reach out to, because things could change quickly between the time that you talk to them and the time that they ultimately pass away. You may not get in front of them again. So I would say that's the range you need to be looking at. So let's talk about business valuation fundamentals. The date, the standard, and the premise of value. And these really set the foundation for what we do. And the primary reason I want to share these with you is because I typically do not move forward on an engagement unless I know exactly what these are. The good news is on estate and gift, they're largely set, at least the first two are really set by what has happened to the deceased and the realm that we're operating in. So I'm going to get to that just a little bit. These are different animals in, say, litigation and some of the other areas I work, but really that third one is typically the only one we really have to think really hard about, just to make sure that we understand what's going on. The other two, we pretty much know where we're operating when the event occurs. But I'll lay that out here. The date of valuation for an estate is the date of death. Pretty easy to understand, right? That one is pretty self-explanatory. The second one I found, especially for the clients, is maybe not so intuitive, and that's the date of valuation for the gift is the date of the gift. And so it's okay to do planning. For example, I'm having people reach out to me now, and they're trying to think about what they might do down the line. And hopefully there are some of your clients are reaching out to you or you're reaching out to them thinking about that. But just understand that you can do the planning, but the date that the gift actually happens is the date of the valuation, and things can change. So be careful that you don't open yourself up to something in terms of an examination where you're not using the right date. And you want to make sure that that valuation report that goes on the back of the gift tax return is that date that that gift happened. Okay. Standard of value is fair market value, and it's in Revenue Ruling 5960. This can be a difficult concept to understand. I like to contrast it with other standards of value, but let me just lay it out basically. This is straight from the language in the code. Fair market value is the price at which the property, that's the business typically, would change hands between a willing buyer and a willing seller. The buyer isn't under a compulsion to buy, and the seller isn't under a compulsion to sell. So it's not a forced sale. That's important to understand. And they both have reasonable knowledge of the facts. Now, what the heck does that mean? I like to contrast that to, say, investment value or strategic value. We're talking there typically about a specific buyer with specific motivations. That's not what this is. So as an example, Bob wants to buy your law practice or your client's business. Bob or Sally or whoever might have unique motivations about what they want out of that business. Very specific things that are important to them. They are not the hypothetical buyer seller. They are a specific one. The other example I'd give is you'd see if you ever watch CNBC or just kind of peruse the Wall Street headlines, a lot of times there'll be an acquisition in an industry and the buyer will pay a premium for the stock. And the thinking behind that is typically when they are able to get the merger through and acclimate that company into their business, they're going to be able to realize more cash flows, ultimately increase their profitability and ultimately their stock price. So they will pay the seller a premium to obtain that. And so that's a different standard of value than what we're talking about here, which is fair market value, hypothetical, not specific. Premise of value, again, this is the one that I just want to make sure I understand. Usually date and standard can figure those out pretty quickly because we know we're operating in the state and gift. Other than if we're doing a gifting, we just need to make sure we know that date when that gift is going, when it happened, and then that's the finalization of the gift. Premise, this is a fork in the road. Is it going concern or is it liquidation? Going concern is the most common one, and that means the business is going to continue to operate. So the person is running the business, they're alive, they're running the business, it's working, and then and then they pass. Basically, the assumption is that it would have continued regardless, right? It was going to continue to run. The other one, which is less common, would be if they were going to liquidate the business, they were starting the process of liquidating the business up to the date of death. And so that would potentially change the premise over to liquidation. Not very common, but it is something that you want to be aware of, because if you were going to use the liquidation premise, it could have typically, not always, but it could definitely have a depressed effect on the value of the business if it's heading in that direction. Revenue Ruling 5960 is our main guide for estate and gift. I'm going to go through the factors to consider. They should be in the valuation report. If you're seeing valuation reports that do not include these, you should be asking the person that's providing this to you why they're not in there. It is important that they are putting these in the report, and more importantly, that they're addressing how they apply to the subject interest. And I'm going to go through that. It'll make more sense in a moment. I like to reference these to the page numbers in the report, so I bullet point them early in the report, and then I go, okay, that's on page 2, that's on page 10, that's etc. And that's where the reader can go and see those because they're right out of the revenue ruling. Here they are. The nature of the business and the history. The example I like to use, and unfortunately a lot of companies don't have these, but it is a good idea to encourage your clients, your business owner clients, to develop something like this, even if it's just in a protected document and it can be pulled out of a drawer if need be. It needs to be updated. What you want to be able to do, what I want to be able to do when I put this into the body of the report is say, okay, what got us to where we are today? What has happened with this business? What do they do? How do they make money? How did they start out? And it could just be a small paragraph. I like to make it as much as I can to give the reader some sense of how it started and where we're at today. And a great example, I had a client that had this, and you've seen them too, right? You'll know exactly what I'm talking about, are those timelines on the wall that you're usually a poster. And it talks about, okay, and in 1980, we opened as a garage company. And then and 5 years later, we were at $1 million in sales. And then 10 years, we were at 10 million or whatever. And they've got a timeline and things that have happened to the company. Those are great to have for this type of piece that I need for the report. The economy and the industry. So most importantly, not just pulling that economic data and that industry data, which I gather is also how does the subject company fit into that? How does the economy impact the company? How does the industry impact that company? What's the growth rate in the industry they're in? What are the risk factors? What are the things that are going well? What are the things that are not going well? So we're going to talk about that in the body of the report. The next three, C, D, and E, the book value, financial condition, earning capacity, dividend paying capacity, I generally put those in one section of the report. It's the financial analysis section. And I've got exhibits in the back of the report where I do all the analysis. And then I've got a written section where I reference those exhibits. And again, most important in my report is that summary paragraph that says, okay, this is what's happened. This is where I think the business is headed and why. And this is how it impacts the value of the company. Book value is pretty straightforward accounting calculation. Financial condition, we're talking about, is it growing? Is it shrinking? Does it have a strong balance sheet? Does it have a weak balance sheet? Those kinds of things. The earning capacity fits into that. The profitability, the cash flows. Can it pay dividends? Has it paid dividends? But really, we're looking at the ability to kick out cash to the owners after the expenses and the taxes are paid. Goodwill, I think this is an interesting one because I get a lot of clients and some real smart people that don't understand that goodwill is not a mystical concept. It is actually something that I can quantify based on the right information. And the basic way that it is typically done is that if it's a profitable business, it's pretty common that the asset approach will be lower than the income and market approaches. So the income and market might be here and the asset might be a little lower here. So for example, and the asset often sets the floor value of the company. And let me give you an example. I'd say I valued the company and I say that income and market, that's where I'm leading. I'm basically going to put a lot of weight on those two. I think it's worth $3 million. The asset approach says it's worth $2 million. That difference, that $1 million, is the goodwill. So it's the difference between basically what I like to call, this is not a technical term, but the fire sale value. If I took all the assets, less the liabilities, and I sold them all off, essentially, I had them appraised and I sold them off. That's typically, if it's a profitable business, it's often a lower number than the market and income. And so that difference between there is an estimate of the goodwill. So it's not a magic trick. It's not a made up number. It's a number you can actually calculate. And that's goodwill or intangible value of the company. Sales of the stock, what's been sold before from the company? Have they had sales between prior owners or people that they bought out and are now gone? I like to put those in the report when I can get that information and show some historical information. It may or may not have a bearing on how I think about the value of the company. I like to get it. It is fairly common, unfortunately, for those records to get lost, but I do ask for those and try to get as much of that information in there that I can. The size of the block, really critically important. In day two, I'm going to talk about discounts, particularly if you're at 50% or lower. Discounts can come into play, discounting of the interest. So we definitely want to know the size of the interest, the size of the block of the stock we're valuing. And I'm typically thinking of that in terms of a percentage. You could think of it in terms of the shares that the interest owns as a percentage of the total shares outstanding. Market price, last definitely, but not least, because market evidence is going to tell you a lot about what people pay for these interests in these types of companies. And so typically I'm going to look at databases which include private company transactions. I may use the public company method, sometimes not, oftentimes not for me because those companies tend to be pretty large, but I'm still going to look at it and see if it can provide me with a reference point. Often when I've used the guideline public company method, it's with a larger company typically, but it's also a company that may be a common target of a public company buyer. So you may have a client, the one I see commonly is in manufacturing, and they may have a really high top line sales. They may have $50, $100 million in sales, annual sales, and they may be a target of a public company buyer. But again, just going back to our standard of value discussion, what they pay in a transaction may not be fair market value. It may be more of a strategic buy and they may pay a premium. But and we work through that piece to figure out what that estimate of the premium that they paid for that would be. Due date, get it on your calendar and right away. Okay. You may have a practice management software. You may have assistants in your office that handle that. That's great. Just make sure that you get it down and that you set up a tickler reminder because it'll come quick. And one thing that I noticed in the world that I live in, particularly when I compare it to, say, a litigation world, litigation for me, we're talking non-IRS work that I do for valuation, tends to move very slowly. You get continuances, you get delays, et cetera. Things just keep pushing that date down the line. That date for that estate tax return is set in stone. You can get the extension, but I can tell you 9 months will come on you fast. And that your clients that are first time executors or trustees, they may see that 9 months and go, wow, I've got plenty of time. And just let them know up front. Try to temper their expectations that that's a long time because it's not. They're busy. 9 months goes by very quickly. All right. So you, often, unfortunately, the extension does happen, which takes us to 15 for an estate. I like to try to get it ready. My part before the 15, I like to try to hit the 9, and I put them both on my calendar. But sometimes, and particularly what I'm seeing now is sometimes people are getting new asset appraisals, or we're still searching for some kind of information that we didn't have. The gift tax return without extension, we're talking about it's going to have to be filed April of the year following the gift. So if you did a gift in 2024, then the gift tax return would have to be filed April of 2025, just to give you a sense of that. States, I'm going to do just a little bit of a deeper dive on states. Over communicate and be proactive, and the wrap up time can be significant. So that's another reason why I try to get it in front of my attorneys and my other clients as soon as I can, because there may need to be some back and forth. Are we sure we have this right? Let's look at it. Let's consider looking at a draft report, make sure we have all the pieces in place before we go and finalize this thing and send it in. All right. This is, you may have heard the term decoupling. You're probably familiar with that. This is when the IRS and the state don't match. And so I just want to bring this to your attention. It probably is already on your radar, but you want to find out all the states that could be required and the exemption amounts for each potential return, and then confirm how many filings are required. And consult with the rest of the estate team on the due dates, but just I would advise you not to rely on them fully, because I like to tell people to cover their backside just to make sure that they don't make a mistake. Do your own due diligence. Make sure that you're covered on this, that you understand what's going to be required. And it is common, and I see this, you probably see this too. I've got one big one right now where we need a state of Illinois, even though we don't need a federal. Just because you don't need a federal doesn't mean you won't need a state, right? And vice versa. So just keep an eye on this, because this is a moving target and it's potentially changing every year. So you want to stay sharp on this. Operating versus holding companies. And I think this is pretty common language in my business, but it may not be the same language you use, but I'm just going to give you a sense of the way I look at this. And the cat will make sense in just a minute. So when I'm talking about operating companies, I'm talking about like a construction company, could be a medical practice, like a doctor, a retail business, a manufacturing company. A holding company, for me, typically, it might be held in an LLC commonly, and it often will have real estate, farmland. It may have an operating company inside it too. I had one a few years back that had a billboard in it. Often the holding companies are going to be things that need to have outside appraisals done. So we're going to get the real estate appraisals for the farmland and the strip mall and all these other things that are in there. And then they may call me to do the valuation of this holding company, write the report, apply the potential discounts and that kind of thing. And these things can get really unwieldy. I mean, they can get really big. The analogy that I've used, the best one I can come up with is like, your garage, if it's unclean, which many of us, the garage can get a little out of hand, especially if you've got kids. And except this stuff is really, really valuable. And so it's kind of, it can be kind of all over the place. And there may be different people involved with getting the appraisals for the different pieces. And I think the temptation is to go, oh, well, this is easy. We'll just stack this together, easy peasy, and it'll be fine if you have everything. And so what I like to say in business valuation and accounting is you will never get accuracy if you don't have completeness. Okay. If you don't have all the assets, all the liabilities, accuracy goes out the window. And so that this is something to really keep in mind and be careful of because there's a real cat herding element to it. It's the best term I could come up with in doing holding company valuations. Organization skills are critical to this. People that aren't detail oriented are going to have a hard time doing this. I have typically created a spreadsheet with all the assets and liabilities and gone back to the attorney and the client and gone, okay, is this all of it? Is this all of it? Is this what you're seeing? Do we have everything? And I think it's important to do this because I had, and I can't remember the exact number. I think it was in excess of $5 million. Actually had one, this happened to me a few years back where I was getting towards the finish line and the client said, I don't see this on there. Do you have this? And I said, and he sent it to me, an appraisal, and it was a very valuable piece of property in a growing area. And I said, no, I don't have that. So it had a material impact on the value of that holding company. I'm going to open it up for questions. I'm over on time. I'm sorry because we got a little late start and that was partially my fault. I'll take responsibility for that. I really appreciate your time and I'll get this recorded and out so that if you want to watch it again, you can, or send it to your colleagues because everybody's really busy. I'll stay on for just a couple of minutes and otherwise have a great day. And I hope to see you on round 2 in a week. Same time on Thursday.